headlines at 4 p.m. Industrial output grows at a better than expected 2.5% from last year's levels as manufacturing activity picks up. Economists say growth cycles may have bottomed out and revival may be on its way. Retail inflation jumps to 10.9% in Feb, much to the discomfort of the government. Bankers and companies keep their fingers crossed as high inflation dampens hope of an interest rate cut in the next week's monetary policy review by the RBI. Indian equities react positively to the better-than-expected RIP numbers, but give up gains as high retail inflation spooks hopes of an interest rate cut. The Sensex ends 80 points down. Consumer durables, power and realty stocks are among the big losers. India's largest cigarette maker, ITC, hikes prices of its key brands, including Gold Flake and Classic. Prices go up by an average of 10 rupees as the company looks to offset the hike in excise duty and value-added tax. A very good afternoon and welcome to Business Day. I'm Sonali Krishna. Now, the index of the industrial production expanded for the first time in 3 months in Jan this year. It's a positive surprise indeed, but can the data be trusted? And will these early signs of recovery push the RBI to cut rates to fuel growth further? Mrinalini Krishna with all those details.
Indian factories are producing more in 2013. The output has jumped significantly in January over the terrible contraction in December. Industrial production grew at 2.4% versus a contraction of 0.6% in December. Manufacturing has jumped a shade under 3%. The contraction in mining has reduced. Electricity, consumer goods have all improved. But it is capital goods that continues to be sluggish. Top policymakers believe the numbers are encouraging and the economy may have indeed bottomed out.
I think this fits in with some of the signals that we've been getting, that basically the downslide is over. Now the question is how fast it can move up.
Yes, it's encouraging. We were aware of it, but we have to do more, both on exports and the industrial manufacturing.
In fact, North Block asserts early signs of recovery will need more growth impulses from Mint Street.
I am confident that we will also have further good news. Inflation numbers are also down. So there is certainly a case for further impulses for growth.
The pickup in IIP indeed lends some weight to the government's optimism about growth rate, both for this fiscal and the next. Contrary to market estimates, the 6% growth looks achievable in fiscal year 14. But that may not be possible without the RBI rate cut after all. The revival in IIP is indeed encouraging, but experts also point out to the volatile nature of this data and assert on the need for an established trend. Besides, investments alone will be instrumental in reviving segments like capital goods, and the fact is that money still hasn't broken ground. Sakshi Batra and Mrinalini Krishna, ET Now, New Delhi.
Now, while industrial production numbers have come in as a pleasant surprise, consumer price inflation for the month of Feb has been a dampener. The CPI has inched up to 10.9%, while food inflation has risen to 13.7%. Anirudh Ghosh joins us for more on this. Anirudh, tell us, how does this impact the thinking at the central bank with less than a week to go for the policy announcement?
Well, certainly the fact that the consumer price inflation, or in fact retail inflation, still remains well in the double digits is a very big cause of concern. As far as the Reserve Bank of India is concerned, it's at 10.9%, very close to the 11% mark, and clearly it's been only going up for the last few months. The RBI has also been pointing out the fact that consumer price inflation still remains a very big cause of concern. The fact that food price inflation has been going up because of various structural bottlenecks, various issues in terms of food production and structural demand issues also coming up. So clearly these things have been weighing on the RBI's mind. They've actually been talking about this in their various policy announcements, and also if you go by what the Governor Dr. Subba Rao has been saying in his past couple of announcements as well, and also in his latest comment he did mention the fact that containing inflation and maintaining inflation expectations within a very tight range is still going to be part of their policy objective. So clearly it does seem that while the RBI did give a rate cut in the past policy statement, there is another policy statement due next week on the 19th. The jury clearly is out at this point of time whether or not there will be a rate cut, though a lot of people in the market are getting jittery. A lot of people had factored in a 25 basis point cut in this policy statement as well. It clearly doesn't seem like it's going to be a given, going by the kind of numbers we're seeing. Also, let's take a look, in fact, at what a couple of market participants had to say when they spoke to the channel earlier today.
In the month of February, food prices have gone up. There's been a fairly significant uptick in certain vegetable prices, which would have kind of had an impact on CPI, which has a higher weightage for food than the WPI. So CPI numbers clearly remain in a territory of discomfort for the central bank.
Food weightage in CPI is close to 50%, and food inflation still continues to be high. And I think that's why it still shows to be on a high level. And this was expected, given that we had a bad monsoon. But the winter crop is pretty good actually, and I think the difference between the WPI and the CPI should start coming down.
And onto the markets, the Nifty failed to close above the key level of 5,950 for the second day in a row, as rate cut hopes from the Reserve Bank diminished on the back of a high CPI figure for Feb. Consumer durables, power and reality stocks are the big laggards. Aisha Faridi is here with all the trading action. Aisha?
Well, a fairly volatile session, really. It was all over the place, especially after the IIP data, and now questions being raised about what the RBI action is going to be come 19th of this month. So there we were, just about testing that 5,900 mark in traded in a band of about 50 to 60 odd points on the Nifty. The losers came BHEL, Bharti, HDFC, Siemens, Sasagoa. You had Axis as well as Power Grid, which were pressurizing the Nifty. On the flip side, a whole host of weakness coming in for the broader markets as well. The Bank Nifty A in particular lost a good 1%. So the entire PSU banking pack, that was down and out in trade. Again, an extremely volatile session coming in there as well. Saw sharp decline post the IIP data, saw some covering midway, and then finally closed in weak by about a good 1%. The losers first, and they included the likes of Shrey Infrastructure, Jain Irrigation, you had Alembic, TB Realty, Bajaj Hindustan, Jubilant Foodworks, Puravankara Projects, and Prestige Estates as well. So largely the pressure points were the entire rate-sensitive baskets, and then a handful of gainers to MMTC, wherein the OFS decision has now been postponed. You had Co-Projects, Finolex as well as Renuka Sugars which gained. Let's see, we've closed in just about below the 50 DMA, failed to breach 5,900 in today's session, but let's see whether or not the weakness actually trickles down to tomorrow as well. We'll pick it up again for trade at 8 a.m. on Trading Calls.
Well, thanks for that, Aisha. And on to the road ahead for the last street. Experts feel markets are likely to remain volatile in the short run, but see a recovery in the markets in the long run. Let's listen in.
We are quite late in terms of reviving the capex cycle or stopping the consumption slowdown in a meaningful way in FY14, even if the rate cuts start to happen in a much more deeper fashion. So what we are looking at is therefore more of an FY15 recovery. My own sense is the market will remain range bound for quite some time till we start to get visibility about FY15, because FY14 is virtually, I won't say a write-off, but I don't see any way in which we can get material upgrades.
Going into March end quarter and the remaining of 2013, I wouldn't expect corporate India to pull through too many surprises on the upside. I think we are in one of those countries, or we are one of a few fortunate countries across the world where the earnings numbers are still going northwards, though at a slower pace. So markets are getting cheaper as you go forward.
Let's get a sense of how the F&O activity today shaped up. Navneet Saluja from our research desk is standing by. Navneet.
Well, it was quite a volatile session today, but if you look at the Nifty futures, which actually shed about 40,000 shares in today's trading session, indicates there was a lot of profit booking which took place today, and no fresh shorts were at least seen on the futures side. So the Nifty futures for the day closed at about 59.30 with premium of about 15 points. And if you look at the options data, the Nifty PCR inched upwards to 1.3 compared to the previous closing of about 1.18, clearly indicating there was huge amount of put writing which took place. and especially you got the lower level put strikes like 5500 adding 18 lakh shares, 5600 strike added 28 lakh shares, 5700 put strike 2 added 12 lakh shares. So at least for the March series, the market is not expecting Nifty to drop to those levels of between 5500 to 5700. On the call side, you saw open interest addition at 6000, which added 8.7 lakh shares. Besides that, even 6200 strike added about 5.6 lakh shares for the day. And talking about stock futures, well, among the Nifty gainers, you had Ranbaxy, where long positions were seen. Even the cement counters like ACC Ambuja saw some renewed buying coming in today. Long positions seen for these two counters. On the short side, you had Kane India, which fell by over 3%. Even Tata Power was down. Short positions were seen for both these two stocks. And from the mid-cap arena, you had Indiabulls Real Estate, Titan, Jain Irrigation, which fell sharply, building short positions on the futures side. And you had Sri Renuka and Voltas, which did well for themselves. And in terms of open interest gainers, you had Mahindra and Mahindra, GAIL, Asian Paints. The maximum amount of open interest was seen on the futures side. While talking about the participation, the turnover was quite good. We clocked about 1.5 lakh crore of turnover on NSE towards the end.
Well, thanks for all of that, Navneet. Now, FMCG major ITC has hiked prices of their 74mm size cigarettes by 10 rupees per pack to offset the effect of higher VAT and excise duty on cigarettes levied in the budget. A CLSA sales note states that the cigarette manufacturer may go in for a price hike across the board later this month post the Tamil Nadu budget. Ajay Sharma joins us with more details. Ajay, good to have you on the show. A big blow for smokers, isn't it?
Well, that's correct, but relief for ITC, because we understand from sources that a price hike has already been done and large dealers have already started charging extra as far as their vendors are concerned. So we understand from sources that about 10 rupees a pack of 10 cigarettes is the kind of price hike which has been done, which bottoms to around 1 rupee for a stick of cigarette. Main brands such as Gold Flake and Classic are the ones where cigarette prices have been increased. We understand that this price hike is amounting to around 15% or up to 15% and takes into account the pressure added weight on ITC ever since the excise duty was hiked to 18% in the budget, and since then several states have been hiking their VAT and some more are expected to hike. So to offset this particular pressure, ITC has gone ahead and hiked prices. However, our written query to the company did not see any response, but we understand from sources that a price hike has been conducted.
Great. Thanks for all that information, Ajay. Let's move on. In a move that could deal a big blow to power, steel and cement companies like NTPC, JSPL, Tata Steel, Monnet Ispat and Hindalco, amongst others, the Supreme Court has indicated it could consider scrapping of all coal mining licenses issued between 2004 and 2009. This after the CBI indicated that coal blocks were allotted in an arbitrary manner during this period. Nitya Balakrishnan joins us with the latest. Nitya, what is the government's defense going to be? After all, there was a ministerial panel that looked into the same issue a while back, wasn't it?
Yes, Sonali, clearly the CBI's recommendations to the Supreme Court is pretty much in line with the CAG report also indicated, which was a loss of 1.8 lakh crore rupees to the government as a result of arbitrary allocation of coal blocks to various sectors between 2004 and 2009. The Supreme Court has taken this report of CBI's into cognizance. It's asked the government of India to file an affidavit before the 20th of April, justifying why our allocation was carried out in the manner that it was. Now, as far as the government is concerned, we've spoken to officials from the Coal Ministry, and they have indicated they will furnish all details as sought by the Supreme Court. But clearly, they're sticking to their guns. They're indicating there was no policy for auction between 2004 and 2009. Several of the state governments were not for it. In fact, more importantly, what they're stressing on, what they're going to be stressing on in their reply clearly, is the fact that they've already set the ball in motion for auctioning of coal blocks. So policy for the same is currently being underworked. An interministerial group has also been set up to actually probe insufficient mining across sectors to coal blocks allocated in this period. The interministerial group has recommended penalty or cancellation of coal blocks, which has also taken place by the government. So clearly the government is lining up its defense, but the Supreme Court seeking this proposal before the 20th of April, clearly not good news for either of the steel, power or, cement majors. that are looking out for the verdict.
Not good news indeed. Thank you so much for all that information. Let's move on. Vedanta Resources Chairman Anil Agarwal has backed the government's efforts to kickstart the economic recovery. In an exclusive chat with ET Now's Nisha Podar, he said that the government's recent reform measures, like the cabinet communication on investment, are steps taken in the right direction, and that these steps have helped companies like his tremendously.
Absolutely. Like in our case, Kane, we've increased the production to 100,000 to 100, but now producing altogether 240,000 barrels. We have a 3 or 4 block which was defense needs to clear. You know, the defense is cooperating tremendous. When we show them that in the US, on the airport, they're digging and producing oil. No, so today's technology is enough to protect whatever they need, but they're helping and they're clearing the blocks. So these are the very good sign where things will move.
And you have extensively spoken about exploration in the oil and gas sector. Now, in your limited space as the owner of Kane India, how far are you expecting it to go?
No, we will produce altogether. We need 20 more companies to come, and we need to build the oil market. And India has, I think, enough resource on hydrocarbon. And if the government is forming the policy for the shale, government forming policy for the exploration, and which is there on the card, and you will see how many investment comes, and there will be at least 10 oil companies in India which will be exploring oil and producing oil.
What about the mining issue? What are the various steps that can be taken by the government to streamline processes in this sector?
There's the only way to, one of the things which I always said as a revenue sharing, keep it simple, don't go on allocation to the public sector or to the private sector, make a transparent policy where people can bid. So it's a win-win. When people, government get the money for the license, is an open bid, people can participate, the whole world can participate, and it can move on.
That was Anil Agarwal exclusively on ET Now. The Food Security Bill, the much talked and discussed bill, the chairman of Commission for Agricultural Costs and Prices, Ashok Gulati, feels the government has been overcautious on the Food Security Bill. He also hopes that the cabinet will take a positive decision on sugar pricing.
For 4 years we had kept an export ban, and if the country was thinking of launching a food security bill, we were a little overcautious in terms of getting the stocks in place. Levy system or monthly release system and all those have to go. And on the pricing front, which is a crucial factor, we have recommended that you need to go by revenue sharing formula rather than through at present the state advised prices, which create many a times distortions at the state level. Hopeful that something positive will happen.
Now, banks in India will need close to 5 lakh crore rupees to meet the Basel III requirements in the next 5 years. While most banks seem to be well placed in terms of capital, analysts say the biggest challenge will be to raise non-equity capital through hybrid instruments. Simran Gill and Aniruddha Ghosh report.
Banks are gearing up to meet the enhanced capital requirements under the Basel III regime that kicks in from April. Analysts estimate banks will have to raise a mammoth 2.7 lakh crore rupees in equity over the next 5 years. Of this, 1.3 lakh crore rupees will be a pure equity component and 1.4 lakh crore rupees will have to be raised via hybrid instruments. Given the relatively risky nature and novelty of these instruments, banks and investors are bound to be apprehensive.
Such instruments, therefore, will carry risk levels and risk perceptions which will be definitely higher than those which one can issue, one can consider in a normal bond issued by any bank.
For now, though, banks are taking comfort from the fact that regulations are being implemented in a phased manner and that equity capital is easy to come by.
Last year, the total allocation was 13,000 crores. And we received 3,000 crores. So out of 14,000 crores, maybe we'll make a request for a similar amount.
Basel III in the initial 2-3 years doesn't really have the pressure. It's only in the last 2 years, and we have already worked out accordingly, and we have submitted our plan to the Government of India.
Basel III will take a toll on banks' return on equity and progressively make equity raising tougher for banks. And with capital requirements moving up to international standards, Clearly, the need of the hour is to develop a bond market. Simran Gill and Anirudh Ghosh, ET Now, Mumbai.
And no interim relief for Sahara's Subrata Roy, who had challenged the attachment of his assets by SEBI. The Securities Appellate Tribunal will now hear Roy's appeal on the 23rd of March. Mrinalini Krishna joins us from the capital. Mrinalini, is this a setback for Subrata since he was seeking urgent relief?
Well, of course, the February 13th order of SEBI had attached properties and frozen bank accounts of Subrata Roy as well as 3 other directors of the 2 Sahara Group companies. This appeal was directed at that. They had these 3 directors as well as Subrata Roy had sought interim relief against that February 13th order of SEBI, and after listening to both sides, in fact, arguments were made on both sides where Sahara contended, the Council for Sahara contended that the Supreme Court order directing SEBI to take coercive action against those 2 companies does not include Subrata Roy or the directors. Subrata Roy is not a director of the company, of any of the 2 companies, does not have any executive powers. He's merely a shareholder. All of those arguments were presented. On the other hand, the SEBI Council said that Subrata Roy was in fact liable to refund this money simply because the Sahara Group companies have failed to meet every direction and deadline that has been proposed by the Supreme Court. There were questions that were raised on the maintainability of the appeal of the Sahara Group companies. After listening to both sides, SAT today said that there are a lot of issues that have to be listened to. There is a constraint of time today, but they need to listen to all the arguments in detail. They do not want to compromise the interests of the over 3 crore investors in the 2 Sahara Group companies, and which is why they've decided that they will not pass any interim order today. There was no interim relief to Sahara today. However, the matter will come up for final disposal on the 23rd of March.
Right. Thanks for all that information, Mrinalini. And with that, I'm afraid we're completely out of time. We hope you enjoyed the show. Thanks for watching.